A 4% bond can destroy you more politely than a 40% stock crash. That is the first thing you need to understand. Most people think danger announces itself with sirens. They think wealth destruction arrives with a screaming headline, a market halt, a bank run. Men in expensive suits pretending to look surprised on television. That is not how the worst destruction usually begins. It begins with calm statements, monthly payments, respectable yield, familiar institutions, and the comforting lie that a promise printed on paper is the same thing as real purchasing power. I have spent most of my life watching capital move. It does not vanish nearly as often as people think. It relocates, it slides out of one pocket and into another. It leaves the man holding the elegant promise and settles with the man holding the hard claim. It leaves the family that mistook normal for safe and settles with the family that understood the system before the system admitted what it was doing. You call that unfair, I call it arithmetic. And right now you are living in one of those periods when arithmetic becomes more important than optimism. The world has loaded itself with debt so large, so ordinary, so socially accepted, that most people no longer feel the weight of it. They talk about home prices, retirement accounts, treasury yields, money market rates, and consumer confidence as if these are separate conversations. They are not. They are one conversation. They are all connected to a single transfer belt running underneath the financial floor. That is the metaphor I want you to keep in your mind. A transfer belt, you can stand perfectly still on it and still end up somewhere you never intended to go. That is what late-stage debt does. It creates the illusion of stability while the belt keeps moving. Salaries still arrive. Account balances still show numbers. Governments still issue debt. Banks still smile at you. Brokers still tell you to stay diversified. People still post photos of kitchens, SUVs, vacations, and new watches. Everything looks normal. But normal is often just a prettier word for unrepriced risk, when a country is disciplined, productive, and financially anchored. The belt moves slowly enough that ordinary savers can live decent lives without studying the machinery. They work, they save, they trust the currency, they buy claims on future cash flows. That model can function for a very long time when debt is manageable and money remains tied to real output. Then success turns arrogant. Borrowing increases because borrowing feels painless during expansion. Government promises grow faster than government revenues. Central banks learn that printing, suppressing, rescuing, and smoothing over every crisis creates less immediate pain than telling the truth. Asset prices rise. Households feel richer. Politicians feel clever. Financial commentators feel important. A culture of paper prosperity replaces a culture of hard balance sheet discipline. That is when the belt speeds up. The dangerous part is that your eyes are trained to watch nominal numbers, not purchasing power, so you think your wealth is holding steady because the digits have not collapsed. Your bond still pays. Your cash still sits there. Your home still has a Zestimate. Your retirement statement still has commas. Your stock portfolio still has logos you recognize. But the belt is not measuring your comfort. The belt is measuring reality. Reality asks only a few brutal questions. Can this debt actually be serviced without dilution? Can these obligations be met without debasing the unit in which they are owed? Can this asset defend itself if financing costs remain high, growth slows, and confidence weakens? Can this household survive if cheap money disappears? Can this company pass rising costs to its customer without losing the customer? Can this government pay what it promised without quietly reaching into every saver's pocket? If the answer is no, then the belt has already chosen a direction. History is filled with societies that learned this too late. The names change, the costumes change, the architecture changes. The language of official reassurance changes, the arithmetic does not. A debt cycle is not a morality play. It is a sequence. First comes real production, discipline, confidence, and a trustworthy monetary foundation. Then comes expansion, credit growth, and the intoxication of paper wealth. Then comes the strain, too much debt, too much promise, too much dependence on low rates, constant refinancing, and public faith. Then comes the reset. Not always a dramatic overnight collapse. Sometimes it is slower, sometimes it is inflation, sometimes it is stagnation, sometimes it is asset repricing. Sometimes it is financial repression dressed up as policy sophistication. Sometimes it is all of them at once. But every reset has the same emotional effect on ordinary people. They discover that what they owned was weaker than what they thought they owned. This is why I get impatient when people talk about safety as if safety were a label instead of a structure. A long government bond is called safe. Cash in a weakening currency is called safe. A house bought with maximum leverage in a speculative market is called safe. A broad basket of domestic equities is called safe. A high-income lifestyle funded with debt is called successful. Most labels in finance are marketing language for people who do not inspect the conveyor belt. You should inspect it. Let me show you what the belt is pulling away from first. The first thing it punishes is long-duration promises. I want you to think carefully about what a long bond really is. It is not money. It is not a business. It is not land. It is not gold. It is not productive machinery. It is a claim to future currency payments. That is all you are lending today in exchange for being repaid tomorrow in units controlled by the same system that is already overburdened by debt. Now ask yourself what happens when the system can only survive by keeping the currency softer than the debt burden. You still get paid and you still get poorer. That is the politest form of financial destruction. I know, no drama, no broken glass, no arresting headlines, just an annual subtraction from real purchasing power while you congratulate yourself for owning something respectable. That is why a 4% bond can ruin you more smoothly than a stock crash. A crash at least offends you quickly. A bad long promise flatters you while it drains you. The second thing the belt punishes is idle cash used as a long-term strategy. Cash has a job. Its job is optionality. It is dry powder. It is flexibility. It is a shock absorber. It is not a shrine. I keep liquidity because I want to be dangerous when others are desperate. That is very different from parking a major share of your life in currency and pretending you have preserved wealth over a decade. Currency is a wasting asset in a system that must dilute to survive. You need some of it. You should not worship it. This is where many people fool themselves. They say they are being conservative. What they mean is that they are hiding from volatility. Hiding from volatility and protecting purchasing power are not the same thing. If your dollars buy less every year, your statement is calm, but your future is bleeding. The third thing the belt punishes is weak equity hiding inside broad optimism. I am not telling you that all stocks are dangerous. I have spent my life buying businesses, but a business is not protected because it trades on an exchange. It is protected because it can defend margins, survive tighter credit, and raise prices without destroying demand. There is a world of difference late in a debt cycle. Weak companies suffer from three directions at once. Their borrowing costs rise, their input costs rise, their customers become more fragile. If they lack pricing power, they are squeezed like a grape. Yet ordinary investors buy them anyway because the ticker is familiar, the index has momentum, or the story sounds modern. That is laziness disguised as diversification. You have to stop confusing ownership with discernment. A company with no moat, too much debt, and customers who vanish at the first sign of pressure is not a compounding machine. It is a paper leaf taped to a tree trunk. It looks attached until the weather changes. The fourth thing the belt punishes is leveraged real estate bought under yesterday as assumptions. People become emotional here because houses are never just houses. A house is identity, a house is status, a house is proof you are doing life correctly. That emotional cargo is exactly why people overpay for them. Real estate can be wonderful. I like productive assets. I like rental streams. I like real claims on scarce utility. But there is a giant difference between productive real estate purchased with discipline and speculative property, purchased on the assumption that rates will stay friendly, buyers will remain plentiful, and appreciation will rescue mediocre math. When affordability is strained, yields are thin, leverage is high, and financing conditions have reversed. Your house is no longer simply shelter plus upside. It can become a beautifully painted trap. You keep feeding it, it keeps asking for more. And because the payment feels manageable month to month, you fail to notice that your future flexibility has been sold to maintain present appearance. The belt loves that kind of buyer. The fifth thing it punishes is lifestyle consumption wearing an investment costume. This one catches more people than any macro cycle ever will because it flatters the ego directly. The financed luxury truck, the designer purchase on installment, the kitchen justified as resale value, the vacation justified as mental health, the upscale neighborhood justified as motivation, the private club membership justified as networking, the second car justified as convenience, the massive home equity line justified as smart leverage. Most households do not blow themselves up with one catastrophic decision. They do it by signing 100 tiny identity contracts. Every one of those contracts sends a little more of their cash flow onto the belt. Every month they work to sustain a picture of themselves that gets more expensive to maintain and less useful in a crisis. You need a phrase for that. I will give you one status debt. Status debt is any recurring financial burden you accepted, mainly so other people would read your life a certain way. It is one of the costliest addictions in the modern middle and upper middle class because it does not feel reckless. It feels earned. The trouble is that late-stage debt cycles do not care what you think you deserve. They care what your balance sheet can withstand. Now let me tell you where people get psychologically trapped. They always believe this time is different because the present always has a better public relations team than the past. Rome thought its institutions were too solid to decay. Germany thought the mark could be managed. Japan thought the boom could carry its own weight forever. Modern investors think technology, innovation, central bank sophistication, and national prestige will somehow cancel arithmetic. Technology matters, innovation matters, productivity matters. I have made a fortune betting on productive capacity and human ingenuity. But ingenuity does not repeal a debt burden that compounds faster than the system's honest ability to service it. Innovation can create fortunes. It cannot magically make every promise in the old order sound again. In fact, new technology often enriches owners much faster than it stabilizes the broad population. That means it can widen social and financial fractures right when those fractures are already becoming politically dangerous. So yes, extraordinary businesses will be built. But no, that does not mean every conventional asset parked inside a strained monetary structure will be protected. This is why I want you to stop thinking like a statement watcher and start thinking like a purchasing power engineer. Nominal return is not enough. Nominal safety is not enough. Nominal diversification is not enough. You are trying to protect your life in real terms, your future meals, your future shelter, your future medical care, your future bargaining power, your future freedom to say no. Those are real things. They do not care what your brokerage screen looked like on a polite Tuesday afternoon. This is where the system shift has to happen inside your head. Most people organize money by product category, cash here, bonds there, stocks there, house there, retirement account there. That is amateur thinking. You need to organize money by function, shock absorber, optionality reserve, productive ownership, hard asset defense, inflation resistance, pricing power, low leverage resilience, global revenue exposure. That is how a serious allocator thinks. You do not ask, is this a bond? You ask, what happens to this claim if the unit of repayment weakens while inflation and refinancing stress remain higher than expected? You do not ask, is this stock? You ask, can this business survive if customers weaken, debt gets expensive, and margins are tested? You do not ask. Is this house an investment, you ask? Would I still like this purchase if appreciation stopped, financing stayed tight, maintenance rose, and I could not refinance my way out of bad math? You do not ask, can I afford this lifestyle? You ask, does this lifestyle make my balance sheet more anti-fragile? Or does it simply make me look successful while reducing my refusal power? Refusal power is one of the most valuable things a financial life can produce. If you have enough liquidity, low enough fixed obligations, and enough productive assets, you can refuse stupidity. You can refuse desperate sales. You can refuse bad employers. You can refuse panic liquidation. You can refuse predatory financing. You can refuse to sell a great asset because the monthly pressure has become unbearable. That is wealth. Everything else is theater. So what should you do when the belt is moving? First, reduce exposure to claims that rely too heavily on the promises of an overburdened system. That does not mean become theatrical, apocalyptic, or all in on one shiny alternative. It means recognize vulnerability. If too much of your life sits in long claims on a debasing currency, you are not diversified. You are concentrated in a polite illusion. Second, Raise the quality of what you own. Favor productive businesses with real pricing power, durable demand, conservative financing, and the ability to earn from multiple geographies or hard constraints in the real world. The best assets in difficult periods are not simply high-return assets. They are assets that can keep functioning while weaker structures crack. Third, keep some dry powder, but know why you hold it. Liquidity should be your servant, not your mattress. Hold enough to survive shocks and exploit panic. Do not hold so much for so long that you volunteer for slow confiscation through dilution. Fourth, reduce consumption leverage with ruthless honesty. If you financed your identity, start unwinding it. Sell what impresses strangers and pressures you privately. Shrink fixed costs before fixed costs shrink your choices. A balance sheet with low ego and low debt can survive environments that destroy fashionable households. Fifth, think globally and materially. The belt punishes people who assume one financial system, one policy regime, one asset bucket, and one currency can safely carry every goal they have. Hard assets, real businesses, productive land, scarce infrastructure, quality franchises with pricing power, and selective exposure beyond the most indebted centers of the financial world deserve more respect than they receive during periods of paper comfort. Sixth, measure success in purchasing power and control, not applause. A portfolio that looks boring but leaves you stronger in real terms is superior to a glamorous setup that depends on easy refinancing and public confidence remaining permanent. Public confidence has a terrible long-term record of permanence. There is another psychological trap I want to break before I finish. People imagine the great transfer will arrive as a single clean event, and because they do not see that event today, they assume they have time. That is not how it works. The belt moves before the crowd feels it. First purchasing power erodes, then affordability breaks, then debt service bites, then weaker assets stop repricing upward and start repricing downward, then liquidity becomes selective, then policy responses create new distortions, then the public realizes the old assumptions are dead. By that point, the people who prepared look lucky. They were not lucky. They were early enough to be called unreasonable. If you wait until the danger is obvious, the belt has already carried the cheapest exits away. I learned a long time ago that investing is not mostly about brilliance. It is about structure. It is about incentives. It is about temperament. It is about understanding which conditions must remain true for your position to make sense. Most people never ask that last question they buy because something has gone up, because an authority blessed it, because their peers own it, or because the payment is currently tolerable. That is not investing. That is rented conviction. And rented conviction gets evicted fast when the cycle turns. You need own conviction. Own conviction comes from understanding the mechanism. The mechanism here is simple enough to say in one sentence: when debt outruns honest production, the system starts moving wealth away from holders of soft promises and toward holders of hard claims. Once you see that, you stop chasing comfort labels. You start asking harder questions. What in my life depends on permanent low rates? What in my life depends on stable currency value? What in my life depends on refinancing instead of repayment? What in my life depends on optimistic multiples instead of durable cash flow? What in my life is consumption dressed as strategy? What in my life would become fragile if the belt sped up from here? Those are adult questions. Most people never ask them because the answers would force them to alter their identity. Not just their asset allocation, but identity is exactly what the cycle attacks. The man who thinks he is rich because he owns the right house, drives the right car, and carries the right labels discovers that he was really a steward of obligations. The woman who thought a safe retirement meant a big pile of conventional promises discovers that promises and purchasing power are cousins, not twins. The household that thought high income guaranteed security discovers that security belongs to clean balance sheets, not prestigious payrolls. You do not need to predict every move of the macro world. You do not need to become a television economist. You do need to stop cooperating with your own fragility. That means fewer soft promises, fewer long claims in weakening units, fewer weak businesses purchased through index laziness, fewer heroic assumptions in leveraged property, fewer identity expenses funded by debt, more resilience, more quality, more liquidity with purpose, more ownership of things that can defend themselves, more room to wait, more refusal power. That is how you step off the worst part of the belt. I will leave you with the hardest truth. The transfer does not ask whether you are a good person. It does not ask whether you worked hard. It does not ask whether you followed mainstream advice faithfully for 30 years. It asks only one thing. When the old promises began to soften, what exactly were you holding? If your answer is long paper, weak claims, peak leverage, and status debt, then the belt already has your name on it. If your answer is discipline, liquidity, productive ownership, real resilience, low ego obligations, and a mind trained to defend purchasing power rather than chase labels, then the same belt that destroys others can carry opportunity toward you. That is the choice. You can spend the next few years protecting appearances, or you can protect purchasing power. You can keep buying what feels normal, or you can start owning what remains real when normal breaks. You can keep letting the belt decide for you, or you can step off it while there is still room to move.